The housing market has always had its risks: job loss, rising interest rates, and economic downturns. But in recent years, a quieter, less obvious factor has been driving a surge in home foreclosures, especially along America's coastlines. That hidden factor is coastal flooding. On the surface, it might seem like foreclosures are mostly about finances. People can't keep up with mortgage payments, and the bank takes back the home. But dig deeper, and you'll find that rising seas, stronger storms, and frequent tidal flooding are quietly undermining property values and putting homeowners in impossible situations. Let's break this down step by step. First, what exactly is coastal flooding? Unlike catastrophic floods caused by hurricanes or river overflows, coastal flooding can happen quietly. Higher tides, storm surges, or even routine sunny day floods can push seawater onto streets, yards, and sometimes right into homes. Climate change has accelerated this, making once rare events a regular occurrence. For homeowners, the impact is financial stress. Frequent flooding leads to higher insurance premiums. Properties in flood-prone zones are often required to carry flood insurance, and as the risk grows, premiums climb higher each year. By 2025, many coastal homeowners are facing record-high costs just to stay insured. On top of that, repair expenses add up. Even small floods can cause thousands of dollars in damage, ruined flooring, electrical issues, mold remediation. Homeowners who experience repeated damage may max out savings, rack up debt, or fall behind on other bills, including their mortgage. Now add in the effect on property values. Imagine trying to sell your home, but buyers know the neighborhood floods several times a year. Demand falls, prices drop, and suddenly your home is worth less than your mortgage. That's called being underwater financially, and it often ends in foreclosure. Banks and lenders see the risk too. Properties in high-risk flood zones are harder to finance. Some lenders refuse to write new loans in these areas, further depressing property values. For existing homeowners, refinancing becomes nearly impossible, locking them into unfavorable mortgage terms. This creates a dangerous cycle. Flooding drives up costs and lowers values, which leads to more foreclosures. More foreclosures weaken entire neighborhoods, creating ripple effects across local economies. And it doesn't just affect the coasts. The foreclosure surge caused by coastal flooding affects inland homeowners too, because when insurance markets collapse or lenders pull back, the shockwaves spread to the entire housing market. Let's take an example. In Florida, nuisance flooding has become a normal part of life in many coastal towns. Streets flood during high tides, even when there's no storm. Homeowners find themselves unable to sell, paying more for insurance, and repairing damage year after year. Slowly, more and more properties slip into foreclosure. Multiply that across thousands of homes, and you see why economists are sounding alarms. So why is this factor hidden? Because it doesn't always show up in foreclosure reports. When a bank repossesses a home, the official reason may be missed mortgage payments. What the data doesn't say is that those missed payments were triggered by rising costs tied to flooding. It's a silent driver, masked by financial paperwork. What can homeowners do about it? The first step is awareness. If you live near the coast, check flood maps, not just FEMA's official maps, but also updated climate projections. Know your risk, even if your lender doesn't require flood insurance. Second, factor flood risk into your budget. Insurance, maintenance, and potential repair costs aren't optional in coastal areas anymore. They're part of the true cost of ownership. Third, explore mitigation. Elevating utilities, installing flood vents, and using water-resistant materials can reduce damage and sometimes lower insurance premiums. While expensive up front, these steps may save tens of thousands over time. Fourth, diversify your financial safety nets. Build an emergency fund specifically for property repairs. Look into disaster assistance programs offered by state and federal governments. And finally, think long-term. If projections show worsening floods in your area, consider whether selling sooner rather than later makes financial sense. While it's hard to leave a home you love, protecting your financial future is critical. For policymakers, the challenge is even bigger. Local governments face declining tax bases as property values fall, even while they're forced to spend more on flood defenses and disaster recovery. Without intervention, entire coastal communities risk a downward spiral of abandonment and economic collapse. This is why economists and housing experts call coastal flooding the hidden factor behind foreclosures. It's not just about water entering homes. It's about the slow erosion of financial security, neighborhood stability, and market confidence. The lesson here is clear. Climate risk is financial risk. Homeowners, lenders, insurers, and policymakers can no longer afford to ignore it. As we move deeper into the 2020s, the connection between coastal flooding and foreclosures will only grow stronger. The sooner we recognize it, the better prepared we'll be to protect families, communities, and the housing market itself. Because when the water rises, it doesn't just wash away property. It washes away financial stability, too. And unless action is taken, foreclosures will continue to climb, leaving countless homeowners stranded in a crisis they never saw coming.